Hello. At Equilibrium, we believe in having open and honest conversations with our clients about what sort of returns they should expect from their portfolios over the long term, and also what level of risk they need to take in order to achieve their desired returns. So as you would expect, we're constantly researching and reassessing what we think the likely returns are from all the various asset classes based on the latest available data. But recently, we think there's been a bit of a shift because we're now in an era where interest rates are basically at zero. Your likely return from cash over the next few years is probably zero. And we don't really see the chance of those rates going back to anything like we've seen in the past, certainly anytime soon. Your yields on things like government bonds are also not very much above zero. So your likely return from things like a UK gilt is probably going to be pretty low. And even things like the property market, which is undergoing some fundamental changes due to the move to online, we don't think is probably going to provide the same level of return that we've seen before. So of the four main asset classes we invest in, three of them, cash, bonds, our fixed interest as we call it, and property, are likely to provide lower returns than they've seen before. And they're some of the somewhat lower risk assets that we can invest in the portfolio. However, we think we could expect some pretty decent returns from equities over the long term, or at least if we're selective with the type of equities that we buy. So in summary, what that means is we think we could achieve some pretty good returns over the long term, but we're going to be relying on the stock market, which is the riskiest of all the asset classes, in order to achieve those returns. So we do have to have open and honest conversations with our clients to say, we may need to make a decision. Do we want to accept that we might need to take slightly more risk and have slightly more in equities in order to achieve the returns that we may have seen in the past? Or do we need to accept that actually we need to just aim for a lower return and not put those risk levels up? So it is a difficult balancing act. We've been through all our investment process from head to toe to see if there's any ways that we can improve on it and help enhance those returns, and we think there are ways that we can do that, and we will continue to work on those. But there may be some clients out there who actually probably should be considering reducing their return expectations and not taking any extra risk, because it may not be suitable for them to do that. So to that end, we are working on introducing a new portfolio which is a bit more defensive. It will aim to be less volatile, have less in the way of drawdown, less risk of loss, but will aim for a lower return, perhaps 3% ahead of cash returns over the very long term. So if you want to read any more about this, you can read our latest edition of Equinox. There's an article called Project Pheonix, which is all about what I've talked about today. But thank you for listening. Please do get in touch if you've got any questions.